March 2023. Panic rips through the streets of regional finance. Within days, Silicon Valley Bank, Signature, and First Republic collapse in a spectacular cascade of modern bank runs. The Federal Reserve steps in, armed with emergency liquidity facilities, to stop the contagion. The immediate fire is extinguished, but the psychological damage is permanent. Regional banks across America slam the brakes on lending. They tighten their credit standards to the most restrictive levels seen since the depths of the 2008 financial crisis. The tap of capital is violently shut off. By all traditional laws of macroeconomics, a massive corporate default wave should follow. When medium-sized enterprises are suddenly starved of credit, they lay off workers, cancel expansions, and default on their existing obligations. A recession is mathematically guaranteed. But the recession never arrives. The defaults do not spike. The corporations keep spending. The money keeps flowing. This is the paradox that has quietly terrified global regulators. If the traditional banking system pulled back, where did the billions of dollars in corporate lifelines come from? The answer lies outside the heavily regulated, brightly lit corridors of the Federal Reserve's banking system. The money came from the shadows. A massive $2 trillion ecosystem of private asset managers who stepped in to become America's new lenders of last resort. They bypassed the banking laws. They bypassed the public stock exchanges. They bypassed the transparent pricing mechanisms of the bond market. Welcome to the era of private credit, a financial machine so large, so opaque, and so deeply embedded in the retirement accounts of ordinary citizens that it has entirely rewired the nature of risk in the global economy.
To understand how risk vanishes, you must understand how it was formally outlawed. In the aftermath of the 2008 financial crisis, global regulators descended upon Basel, Switzerland, to rewrite the rules of global banking. The resulting frameworks, Dodd-Frank in the United States and Basel III globally, put traditional banks in a regulatory straitjacket. Banks were forced to hold massive reserves of high-quality liquid capital. They were subjected to brutal stress tests. Most importantly, they were forced into strict mark-to-market accounting. If a bank held a loan and the macroeconomic environment worsened, the bank had to publicly mark down the value of that loan and report the loss immediately. Transparency was hailed as the ultimate cure for systemic risk. But money is like water. Block its path, and it will simply find a new channel to flow through. The regulations made it incredibly expensive and capital-intensive for banks to lend to slightly risky, mid-sized corporations. The traditional syndicated loan market, where a group of banks would pool money to fund a company, became slow, cumbersome, and heavily scrutinized. Meanwhile, the public bond markets demanded endless disclosures, quarterly earnings calls, and the constant threat of public panic selling. Corporations needed a third option. They needed capital that was fast, flexible, and quiet. Wall Street's largest private equity firms saw the vacuum and stepped into it. They realized a fundamental truth. You do not need a banking charter to lend money. You just need capital. Instead of a corporation going through a tortuous 6-month roadshow to issue a public bond, they could simply walk into the offices of a private asset manager. The asset manager would write a single massive check, often hundreds of millions, sometimes billions of dollars, directly to the company. The terms of the loan are strictly confidential. The debt is never traded on a public exchange. There is no daily ticker symbol flashing red on a screen. Because the loan is private and illiquid, the asset manager does not have to mark it down every time the Federal Reserve raises interest rates or the stock market violently swings. The valuation is kept internal. A mathematical model dictates what the loan is worth, insulated from the psychological panic of the open market. Over a decade of zero interest rate policy, this mechanism transformed from a niche financing tool for distressed companies into a dominant force in corporate America. By 2024, the private credit market swelled to over $2 trillion. It is no longer just funding risky tech startups. It is financing healthcare networks, software conglomerates, industrial manufacturers, and real estate empires. The traditional banking system is slowly being hollowed out, replaced by a shadow architecture where the rules of gravity are entirely self-reported.
The architects of this shadow empire are not the household names of retail banking. They are the titans of alternative assets: Blackstone, Apollo Global Management, Ares, and KKR. These firms have evolved far beyond their origins as corporate raiders and buyout shops. They have become sprawling financial supermarkets. But to lend billions, you must first source billions. Without the ability to take in FDIC-insured consumer deposits like a JP Morgan or a Bank of America, the private credit titans had to find a different pool of capital. They found it in the deepest pockets of the global financial system: pension funds, sovereign wealth funds, and life insurance companies. The incentive structure linking these entities is a masterpiece of financial engineering. Pension funds and insurance companies face a structural nightmare. They have guaranteed liabilities, promises to pay retirees and policyholders exactly what they are owed, exactly when it is due. To meet those obligations, they require a constant, predictable yield. During the 2010s, when government bonds yielded close to zero, these institutions were starving. They faced massive funding shortfalls. The private credit firms offered them a lifeline. By locking their money up in illiquid private loans for 5 to 10 years, pension funds could capture the illiquidity premium, earning yields of 8%, 10%, or even 12%. The asset managers secure long-term unwithdrawable capital, allowing them to charge lucrative management fees without the fear of a sudden bank run. The pension fund gets the yield it desperately needs to stay solvent. And because the loans are not publicly traded, the pension fund's balance sheet looks remarkably stable. There is no volatility. The line on the chart remains smooth, upwardly sloping, unbothered by global pandemics, supply chain shocks, or geopolitical wars. This dynamic sparked a massive structural convergence. Asset managers began directly acquiring life insurance companies. Apollo's integration with Athene became the blueprint for a new kind of financial behemoth, a closed-loop system where grandma's life insurance premium is instantly recycled into a high-yield private loan to a mid-sized software company. It is a brilliant, highly efficient machine. The asset manager becomes the ultimate middleman, capturing risk-free fees while the institutional investors absorb the credit risk. Everyone is satisfied. Everyone is getting paid. The system works flawlessly, so long as the underlying corporation actually generates enough cash to service the debt.
The illusion of stability shatters when the cost of money violently changes. In 2022, the Federal Reserve begins the most aggressive rate hiking cycle in modern history, pushing interest rates from 0 to 5% in a matter of months. The era of free money is abruptly terminated. For the corporate borrowers trapped inside the private credit ecosystem, this is a lethal shock. The vast majority of private credit loans are floating rate. As the Fed hikes, the interest payments on these multi-million-dollar loans instantly double. A mid-sized logistics company that was comfortably paying 6% on its debt suddenly finds itself bleeding cash to service a 12% interest burden. In the public markets, this kind of stress is visible immediately. Bond prices crash, credit default swaps spike, ratings agencies downgrade the debt. But in the private credit market, the surface remains entirely placid. The valuations barely twitch. The global regulatory bodies watch this calm with growing dread. The Bank for International Settlements, the central bank for central banks, issues a stark, unusually blunt warning. They flag the private credit market as a systemic blind spot, a massive buildup of leverage hidden entirely from regulatory view. The Financial Stability Board and the Federal Reserve echo the alarm. They see a looming maturity wall, hundreds of billions of dollars in corporate debt coming due in the next 3 years, needing to be refinanced at radically higher interest rates. The math does not work. The cash flows of the underlying companies cannot support the new cost of capital. So how does the private credit market avoid a default wave? They use a mechanism called extend and pretend. When a company cannot make its cash interest payment, the asset manager simply alters the terms. They deploy payment in kind, or PIK, arrangements. Instead of demanding cash, the lender allows the borrower to add the missed interest payment to the principal balance of the loan. The company avoids formal default. The asset manager avoids writing down the value of the loan. The pension fund continues to see a smooth, stable return on its dashboard. The loss is not realized. It is merely capitalized and pushed into the future. The debt grows larger. The leverage multiplies in the dark. Regulators are paralyzed because they lack the jurisdiction and the data to intervene. The loans sit in private funds, domiciled in business-friendly jurisdictions, far away from the strict capital requirements of Basel III. The traditional banking system is safe, exactly as designed. The banks are not holding the toxic debt. But the risk has not evaporated. It has simply been transferred to the retirement accounts, the life insurance policies, and the sovereign wealth funds of the global public.
The conflict is no longer between banks and regulators. It is between the mathematical reality of corporate cash flows and the psychological barrier of private valuations. Asset managers argue that their private model is actually safer, that their ability to quietly restructure loans prevents the very panics that destroy public markets. They claim they are providing bespoke, patient capital that saves companies from the brutal short-termism of Wall Street. But the sheer scale of the leverage tells a different story. The system has become deeply interconnected.
If a significant portion of these highly leveraged companies ultimately fail, if the PIK loans compound to a point where bankruptcy is unavoidable, the losses will violently rip through the portfolios of the institutional investors. The public will bear the cost, not through a taxpayer bailout of a bank, but through the silent devaluation of their pensions and insurance payouts. The tension mounts as the maturity wall draws closer, a slow-motion collision between gravity and a $2 trillion black box. There is a fundamental law of macroeconomics that cannot be legislated away. Risk cannot be destroyed. It can only be transformed, transferred, or hidden. The history of modern finance is a relentless game of regulatory whack-a-mole. Every time a system is reinforced to prevent the last crisis, the capital migrates, seeking out the path of least resistance, building the architecture for the next one. We constructed a monumental regulatory apparatus after 2008 to ensure that commercial banks would never again hold the global economy hostage. We demanded transparency, liquidity, and immediate loss recognition. We succeeded in locking the front door. But in doing so, we pushed the most aggressive, leverage-heavy borrowing out of the sunlight and into the shadows. The $2 trillion private credit boom is not an anomaly. It is the direct, logical consequence of our demand for safety. It is a monument to human ingenuity in bypassing constraints. The system operates on a breathtaking psychological premise: the belief that if an asset is never sold and its price is never publicly quoted, the volatility does not exist. It is the financial equivalent of covering your eyes to avoid a storm. The private asset managers have built a parallel banking system that offers yield without panic, leverage without disclosure, and debt without consequence. They have engineered an ecosystem where the very concept of a default can be negotiated away behind closed doors, subsidized by the patient capital of the global working class. But paper wealth is only real until someone demands the cash. The mechanism of extend and pretend works flawlessly during periods of economic expansion, masking the rock beneath the surface. It delays the reckoning, allowing the debt to compound in the dark. The ultimate test of this shadow architecture will not be a sudden crash of the stock market or a collapse of a regional bank. It will be a slow, grinding attrition as higher interest rates suffocate the underlying businesses. When the internal models can no longer hide the insolvency of the borrowers, the losses will materialize, hitting the pensions and policies of those who thought they were insulated from the casino of Wall Street. As the maturity wall approaches, the global economy stands entirely dependent on a financial machine it cannot see, regulate, or control. The risk did not disappear. It just changed its name. What happens to the financial system when the shadow bank finally faces a run?